Between February and November 2024, the world's wealthiest insiders didn't quietly trim their holdings. They unloaded more than $50 billion in stock in massive coordinated waves that immediately set off alarms across Wall Street. Jeff Bezos sold $13 billion worth of Amazon shares. Mark Zuckerberg sold more than $9 billion in Meta across multiple transactions. Jamie Dimon, CEO of JP Morgan Chase, sold stock for the first time in his entire 18-year tenure. Larry Ellison dumped $3 billion in Oracle. The Walton family cashed out $2.3 billion in Walmart. And Nvidia insiders, riding the AI boom to all-time highs, sold more than $1.2 billion, while publicly insisting that the best is yet to come. This isn't rebalancing. This isn't estate planning. This isn't tax optimization. This is an exodus. The smart money is sprinting for the exits, and they're doing it at the exact same moment, using the exact same playbook they used in 2007. Right before the financial crisis wiped out $16 trillion and sent the market crashing 57%, most people miss the significance of who is selling. These aren't ordinary investors. Jeff Bezos built Amazon from a garage into a $2 trillion empire over 30 years. He has survived the dot-com crash, the 2008 crisis, COVID, and he has never sold at this speed or scale. Jamie Dimon has led America's largest bank since 2005. He guided JP Morgan through 2008, absorbed competitors, stabilized markets, and in nearly 2 decades never sold a single share until now. These men don't panic. They don't guess. They don't trade feelings. They operate on internal data, deep analysis, and real-time information that the public never sees. And right now, that information is telling them something unmistakable. Get out. Before we look at names and numbers, you need to understand why insider selling matters. Insiders are executives, directors, and major shareholders with access to non-public data. They see trends long before they hit earnings reports. When they buy or sell stock, they must file with the SEC within 2 business days. These filings are public, but most people never bother to read them, and they should, because insiders see things the public doesn't. Bezos doesn't just see quarterly Amazon earnings. He sees daily gross merchandise volume, advertising performance, margins, competitive threats, and problems months before they surface. Jamie Dimon doesn't just read economic headlines. He sees real-time loan defaults, rising delinquencies in commercial real estate, credit card charge-offs, and corporate bankruptcy pipelines forming beneath the surface. This is information that won't appear in the news for months. When insiders sell heavily, it means they see trouble forming. The Washington Service, the most comprehensive insider tracking firm since 1975, monitors the insider sell-to-buy ratio, how many dollars insiders sell for every dollar they buy. A healthy range is 2-to-1 to 3-to-1. Executives get paid in stock and occasionally sell to diversify or pay taxes. But when the ratio spikes above 5-to-1, it's a warning. Above 8-to-1, it's a screaming alarm. In 2024, the ratio hit 9-to-1 for the year, and in some months, 12-to-1. Insiders sold $9 of stock for every $1 they bought. The last time readings were this extreme was 2007, and we already know how 2008 ended. Now, look at the names. Bezos filed to sell 50 million Amazon shares early in 2024, executing around $8.5 billion in February and March when Amazon traded around $170, $175. Then he filed another plan in July, selling $4.5 billion more through the summer and fall, over $13 billion total, his largest and fastest liquidation ever. He blamed taxes. But Bezos has been a billionaire for 25 years. He could have moved to Florida any time. He moved in 2024, at the peak. That's not tax planning. That's market timing. Zuckerberg sold stock every month in 2024 through 10 B5-to-1 plans. January, $200 million, February, $400 million, March, $550 million, and more every month. By November, he had sold more than $9 billion of Meta. Meta had tripled from its 2022 lows, soaring past $500. Zuckerberg controls Meta through supervoting shares. He doesn't need to sell to raise money. He can borrow at 3 to 4% indefinitely. He sold because prices were at records, and he wanted cash. Jamie Dimon's sale is the most alarming. For 18 years, he held every single share of JP Morgan stock he earned. through 2008, through COVID, through every crisis. Yet in 2024, he sold 1 million shares, worth roughly $160 million. The public excuse was estate planning. Dimon is 68. He could have planned his estate in 2010, 2015, or 2020. He chose 2024. Jamie Dimon sees real-time default rates, borrower stress, liquidity issues, and corporate failures unfolding before the public. If he sells, something is wrong. Larry Ellison sold $3 billion of Oracle after the stock doubled on AI demand. He doesn't need liquidity. His sale signals valuation risk. The Walton siblings sold $2.3 billion in Walmart, which is extremely rare for a family that holds stock for decades. Nvidia insiders sold over $1.2 billion, even as they claimed publicly that AI has unlimited upside. These people don't sell their life's work at the top unless they see what's coming. Total insider selling reached $464 billion in 2024, second only to 2007's record. If current pace continues, 2025 will surpass even that. This is the largest coordinated insider exit in modern history. 5 patterns prove why that matters. First, insiders always sell 6 to 24 months before major peaks. They did it in 1987, in 2000. And in 2007, second, when the sell-to-buy ratio exceeds 8 to 1. A crash has followed every time since 1975. Third, insiders in the most overvalued sectors sell first. In 2000, tech insiders dumped the bubble. In 2007, financial CEOs dumped the subprime bubble. In 2024, tech and financial insiders are selling again. Nvidia, Meta, Amazon, Oracle, JP Morgan. Fourth, when long-term holders sell Bezos, Zuckerberg, Dimon, Ellison, the top is almost always in. Fifth, when insider selling exceeds $400 billion, markets do not make new highs for 3 to 5 years, ever. What are they seeing? The Buffet indicator at 185%, nearly double fair value. The Shiller Pay at 34, a level reached only before crashes. Margin debt near $950 billion, ready to unwind violently. Commercial real estate vacancies of 40 to 50%, corporate debt rolling over into interest rates companies can't afford, federal debt spiraling to unsustainable levels, and internal company data slowing sales, rising delinquencies, margin pressure that won't reach headlines for months. Put this together, and the timeline becomes clear. Historically, crashes hit 6 to 18 months after peak insider selling. With 2024's spike concentrated in Q2 and Q3, the danger window is Q3 2025 through Q2 2026. The system is fragile. Any shock, a bank failure, a corporate default chain, a commercial real estate panic can trigger the cascade. And when it happens, margin calls, algorithms, and forced selling will accelerate the decline. A 30 to 50% drop is not theoretical. It is historical precedent. The winners, the insiders who already sold, people holding cash and gold. Investors who buy quality assets at half price after the crash. The losers, the middle-class retirees, pensions, insurance funds, and anyone holding leveraged positions. You can't stop the cycle, but you can prepare. Reduce risk, raise cash, hold some gold, build a buy list, prepare psychologically for volatility. Because the billionaire exit is real, the data is clear, the pattern is repeating, and the crash window is approaching.